where are gold prices headed, and what are the consumption patterns looking like? To discuss exactly this, we now have Kinjal Shah, Co-Group Head and Senior Vice President at ICRA, now joining us. Kinjal, thank you so much for taking your time out and joining us here on ET Now. And before we talk about prices, let's talk about consumption. In FY25, although in value terms we have seen an uptick, but that was led by the surge in gold prices that we have seen. But now, going ahead, what does the outlook look like for FY25? Is volume decline likely to continue this year as well?
Before I start with FY26, let me just give you how we've seen the volume for FY25. So for the industry, we did see a decline in volumes by roughly 7% on the gold jewelry side in FY25. And that was largely because of the fact that you saw roughly around 33% increase in the gold prices in FY25, which resulted in deferment of non-discretionary purchases. So that overall resulted in a 28% YY growth in terms of overall value of consumption. FY26 YTD, as you also mentioned, we've seen roughly a 20% plus increase in the gold prices. This in our view is going to result in another 9 to 10% decline in volumes for gold jewelry in FY26. Overall, because of the higher realizations in FY26, we would still continue to see value consumption being higher by around 12 to 14% in FY26, but a volume decline of around 9 to 10% for the gold jewelry.
Volume decline is likely to continue in FY26 as well. But let's talk about prices then. Although we have seen a run-up of nearly 26% this year so far, gold prices are down nearly 4 to 5% from the all-time high levels. At ICRA, what is your assessment of where gold prices are headed for the rest of the year, given geopolitical developments and how they are shaping up?
So as of now, when I say our estimates are around 12 to 14% value consumption for FY26, we take around 18 to 20% increase in gold price for the year and 9 to 10% volume decline. So that's what we're looking at. So current prices that we've seen post the decline, we expect these to stabilize at these levels.
Prices are likely to stabilize at current levels. So that's as far as gold prices are concerned. But if you can split demand trend for us or volume trend for us in terms of consumption and investment, especially because of the kind of run-up that we have seen of late, is investment demand expected to inch higher, or that is also expected to decline in the current year?
So FY25, if I were to talk about, like you mentioned that the gold jewelry segment did see a volume decline of 7%. As against that, the investments in gold bars and coins, that saw a 25% increase. That typically shows the movement to safe haven investments typically during these geopolitical crises. So that's why overall, if I were to look at the volume decline in FY25, including both the gold jewelry and the gold bars, that was roughly a 2% decline. Now FY26, we expect the investment in gold bars and coins to increase by another 10% over FY25. Which coupled with the 9 to 10% decline in gold jewelry, which we are expecting, that would translate into overall 4% volume decline for gold in FY26.
That's as far as volume trend and pricing trend is concerned. But let's also talk about margins for the entire gold industry and the gold consumption space. I believe margins had risen in FY25, but they are likely to decline in FY26. Help us understand how much could margins decline by, and what will the main reason for that be?
So actually, ICRA expects an improvement in the operating margins by roughly 30 bits in FY26. This is largely stemming from the fact that if one were to look at FY25, because of the custom duty cuts that happened, the 9% duty cut, and because of which we saw a roughly 5% overall decline in the gold prices immediately. Some of these jewelry companies, they saw inventory losses to the extent of 0.5 to 1% of their overall revenues. Since these will not recur in FY26, we expect that this would give a bump to the overall margin for FY26, coupled with the fact that now the jewelry companies are also moving to an asset-light model, franchisee-led model, where there would be profit sharing with these franchises. So when you adjust for that, that overall share of profits going to the franchises Overall, we expect that the margins in FY26 should improve by roughly 30 bits. That's at the EBITDA level. But if one were to look at the net margin level, there the margin expansion would be restricted primarily because of the fact that the borrowings for these jewelry companies have increased because of higher inventory levels because of the prices of the gold. Also, these companies typically use gold metal loans as the source of funding, where we have seen that certain banks did increase the rates of gold metal loans by roughly 300 to 500 bips in Q4 of FY25. So the overall full year effect of these cost increases will be seen in FY26 on the interest cost. That will actually restrict the overall margin expansion at the net margin level in FY26.
So that's your outlook as far as margins are concerned, gross and net for FY26. But I was going through your report and it says that revenue growth will be led by price appreciation, which we already spoke about, planned retail expansion and market share gains for the unorganized sector. Can you elaborate the third part for us? How do you expect the organized versus unorganized market setup to evolve over the next 1 or 2 odd years?
Yeah, so currently our estimate is that roughly the organized segment is contributing to around 1/3 of the overall gold industry. 2/3 of the industry is still contributed by the unorganized segment. Now, because of these custom duty cuts which we saw last year in July 2024, our expectation is that the illicit trade or the illegal, if I were to call that trade, that would actually reduce a lot. And this will give a boost to the organized segment. And overall, the organized segment is actually pretty high on capacity expansions in terms of planning addition of more retail stores. They are also actually focusing more on the digital trade. So all these and the penetration in the tier 2 and tier 3 cities is also actually increasing. So combined effects of both the increase in expansion plans by the organized retailers as well as overall our understanding that the trade would move from unorganized to organized players, we expect that the growth in the organized segment would be higher. So in fact, for our sample set of organized players that we typically track, we expect that the revenue growth for our sample set would actually exceed that of the industry where I talked about 12 to 14% value expansion. Our sample set would see a higher revenue expansion of 14 to 16% because of the fact that the trade would move from the unorganized to the organized segment.
Trade is likely to move from the unorganized to organized sector, and that trend is likely to continue for the foreseeable future. But also wanted your thoughts on the expansion plans from the companies that you spoke to in the organized market. How are these companies looking to expand, especially because volume growth has been limited on account of the price appreciation that we have seen? So do their expansion plans, are they intact? And what is your outlook as far as expansion strategy of the entire ecosystem is concerned?
Yeah, as of now, I think we don't expect any change in the expansion plans of these retailers despite the impact on volumes. I think the industry has been well aware about the pressure on volumes which is there. And in fact, the expansion plans will only help support the overall volume growth for these organized players. As per our ICRA estimates, we expect that overall in terms of store expansion for our sample set players, the expansion would be somewhere to the extent of 17 to 19% of the existing stores that are there. In FY25, this was similar at roughly around 14-15% of the stores which were there as on March 2024. We expect this expansion to continue at 17 to 19% of the base in March 25. And like I said that most of this expansion will be driven by the asset-light franchisee route and also penetration in tier 2 and tier 3 cities.
That's as far as expansion plans are concerned of the entire sector. Kinjal, thank you so much for taking your time out and joining us here on ET Now and helping us decode what the outlook for the industry looks like. But let's refocus then and let's talk about something that's sweet